like to hear the gravel drop beacon here. We'll start with Mr. Poilievre and on to Mr. Fragiskatis.
Thank you very much, Mr. Chair, and thank you to Mr. Leduc and Mr. Matchin, not just for your appearance, but also for the openness with which you've shared information with members of Parliament and remained transparent while you do a very difficult job in a tremendously unusual time. I'd like to discuss the times we're in. I think all of us expected catastrophic drops in the market in as soon as the governments of the world started locking their workforces down. And that did happen, albeit only briefly. In the late March, markets crashed, and by about a third here in Canada, roughly the same in the United States, but then they came roaring back. That bounce back seemed to coincide with the enormous amount of money that our central banks have been printing. Here in Canada, it's now about $400 billion of what is effectively quantitative easing through a bond buying program. In the United States, there's been a similarly large program of purchasing assets, an extraordinary purchase of bonds, not just government bonds, but now also private bonds. In Canada, the bank is buying $10 billion worth of private sector corporate bonds. And the result is that markets are surprisingly valued. According to the Case-Shiller price earnings ratio, the S&P 500 this week was 28, which is extremely high. It's only been that high in the lead up to the tech bubble bursting, and in late 1929, right before the great crash that led to the Great Depression. So I want to get your impressions on how our markets are valued right now, and whether you think there is a bubble, and if there is, how are you protecting the $409 billion over which you and your fund is the custodian?
Yeah, thank you. Really important questions. And I think before I give an answer, let me go through what skills we have as an investor. And that is, we think we have very good skill at building a diversified portfolio around the world. So we're figuring out what the best long-term portfolio is and diversifying that.
Time for another quick one, Pierre. I've been letting everybody go over time because we have a fair bit of time today. Go ahead, a quick one though, if you could.
Thank you very much, Mr. Chairman, and thank you for your answer. And by the way, I'm glad you said you're not trying to time the market. We didn't hire you as a day trader. We hired you because we know you have the brain power to find good value and invest for the long run, and that appears to be what you're doing. So I want to ask about interest rates, and you're not a fortune teller, but you do understand finance better than almost anyone. And I want to ask you about whether or not you worry that in 2 or 3 years, this extraordinary amount of new money pouring into our system could lead to inflation. I know everybody claims the short-term problem is deflation, but I'm talking about the medium term. All of this money is going to stay in our sloshing around in the economies of the world. And if it does, then inflation will result, and interest rates will have to go up to contain that problem. How sensitive is your book? First of all, do you agree with that? And second of all, how sensitive is the $409 billion that you have invested on our behalf to future increases in interest rates?
Yeah, so I think it's an excellent question again. I think the risk of inflation is real. It's quite possible. I think there've been massive deflationary pressures for years, whether it's demographics, whether it's technology, and or whether it's globalization. Those things have resulted in deflationary pressures generally around the world. If you I think the first two forces are probably likely to stay in place. The third one is a question mark as to whether that is really going in reverse, and that also could exacerbate potential inflationary pressure over time. I don't, as a fundamental forecast, we're not predicting as a base case inflation. So if you look at world inflation, we expect inflation in our central economic forecast to be about 2.4% for 2022, 23, 2.5% 2024. And in Canada, we see inflation in a similar sort of 2.5 to 2.6% range, and in the US, 2.9 to 3% in that time frame. But that's a central forecast. There are clearly risks. I think our interest rate sensitivity, we publish in the annual report on page 165, and we show that if you hold all the other variables constant, a 25 basis point move in interest rates would result in nominal risk-free rates would result in an increase or decrease in value in the portfolio of about $2.5 billion. So that's as of March 31. So that's the sensitivity. The longer-term rates are so that's the sensitivity basically. It's about $2.5 billion of sensitivity to the debt instruments in the portfolio. Putting it through the rest of the portfolio is a complicated exercise, but again, part of it would be making sure that we have, again, that diversified portfolio. We have sufficient investments in inflation-protected assets. We have a substantial real assets portfolio. We have substantial investments in equities, of which quite a few of those will perform reasonably well even in an inflationary environment.
Okay, we'll have to end that round there.
Well, it looks like Pierre Poilievre is going to be the leader, so we're going to see a lot more of that type of drilling down and finding out where the money is going. Leave your comments down below, like, subscribe, and have a good day.